few seconds more. Okay. So welcome everyone. Good evening or good morning if you are in the US and or in Europe. It's my great pleasure to welcome you to this E-Axis seminar on climate change, macroeconomics and finance. Today we will have a paper on green quantitative easing, and I'm very happy about it because green quantitative easing was probably one of the first ideas that people came out with when they were speaking about monetary policy and climate change. So it's an idea that has been floated for a long time now, and I'm particularly happy to see Alessandro Ferrari and his co-author Valerio Nispi to have had a closer look at that and a look from a central bank's perspective, and I think that will bring a bit validation or seriousness and to the idea, and I'm happy that central banks are looking at it from a very research perspective. I'm looking forward to see what Alessandro will say about it. In the meantime, let me just remind you that parallel to this forum, there is a Slack page, and this Slack page is a workspace for a community of researchers, regulators, and central bankers that are working on the issue of climate change and the environment. There you will find a comprehensive stream of working papers, news, and conference information, and you can also exchange ideas there. So I think the link will pop up after this presentation, and you're welcome to join this as well. Also, before starting, I would like to remind you that on the 22nd of February, we will have a policy panel on proposals such as Green QE that will be presented today, but also on proposals relating to collateral framework, prudential regulation, and long-term refinancing operation. For this panel, we will have Katrina Assenbacher from the ECB, Emmanuel Munch from the Deutsche Bundesbank, and Maria Nieto from Banco de España discussing some policy proposal currently on the table. So just pencil the date. You can find the link to register on the webpage. So let me introduce Alessandro to you. Alessandro joined the Economic and Research Department at the Bank of Italy in 2016 as an economist at the Monetary Policy Strategy section. In 2019 and 2020, he worked at the ECB as national expert in the Monetary Policy Strategy division. He received his PhD in economics and finance from Bocconi University in Milan, and his research in the last year spanned from the effects of demographics on macroeconomic and financial variable, the two-way relationship between inequality, heterogeneity, and the transmission of monetary policy, and the effect of monetary policy on climate change. You've seen that just on your screen now, there are 3 questions that I would like you to answer now. This is just what you think about central banks and greening the financial system. I will let you a few seconds to answer them, and maybe we can start with the answers of this poll. The first question is, should quantitative easing be tilted to support the greening of the financial system? And the second question, in your opinion, would green quantitative easing have a positive welfare effect? If you have voted, maybe we can see the answer of this. So it's pretty unanimous on a yes, that quantitative easing should be tilted to support the greening the financial system. and that it would have positive welfare effects. So with these two answers in mind, Alessandro, I leave you the floor, and maybe you will tell us more about whether these answers are true or not, or what are the important points to discuss on this issue.
So thank you, and thank you for inviting me to present my paper, my research, that is joint with Valerio Nispilandi. We are both from Bank of Italy, so it is important to remember that clearly we are just expressing our opinions that do not necessarily reflect those of the Bank of Italy or the Eurosystem. And so I'm really happy to be here today to present this paper that is, so we called it Whatever It Takes to Save the Planet, Central Banks and Unconventional Green Policy. So just a brief introduction. I think that the people that are here and that follows this forum knows the problem very well. So CO2 emission has been increasing for decades, starting from the Industrial Revolution, and now they are projected to increase for like at an exponential level for the next decades. So apparently, according to climate experts, this increase in CO2 emissions has driven a rise in global temperature, and that is now worrisome and is now above around more than 1 Celsius degree, according to the average of the pre-industrial era, and is expected to increase further if we don't take action. And pressure on policymakers has been increasing from the scientific community. And here we are reporting, for example, the World Scientists' warning of a climate emergency, saying that clearly and unequivocally that planet Earth is facing a climate emergency. So that something has to be done, and has to be done quickly. And also from the public opinion, there has been an increasing in support and in pressure on policymakers to try to do something to stop the climate change. And this has also also on central banks, so also on financial institutions and specifically on central banks, there has been an increasing pressure from the public opinion and from policy and from debate, policy debate to act somehow to stop it. So what is climate change, and so how we can see the climate change pollution problem in an economic model, is the classic example of a negative externality that all of us have studied when we were doing probably Micro 101. So ideally, Pigouvian taxation is the optimal solution. So the policymaker should put a tax on emissions, on pollution, to internalize the negative effects that pollution has on climate, and to restore it, to bring the economy to an efficient allocation. But nonetheless, there are problems, and especially governments are not always in a good positions to raise taxes. So we also know that there are some political economics argument to say that somehow the fact that climate is a tragedy of the horizon, using the words of Carney, that was the former governor of the Bank of England. So basically that everyone knows that if we don't act, then there will be irreversible damage. But at the same time, the political cost of raising taxes today is really high, and the benefits of are uncertain and really far in the future. So it's hard that elected politicians are willing to act. So also based on this argument, there has been a debate on what can central banks do, because potentially they are in a better position. They are independent institutions, and so they can take these actions looking at the long term instead of being focused on this or being trapped in this political economics problem that I was mentioning. So for example, so especially the ECB, as while starting the strategy review, the President Lagarde explicitly mentioned the fact that we would have studied as Eurosystem members, and we are studying, we are looking on how to fight climate change and how to address the climate change problem inside the central banks and inside the Eurosystem. So there has been, there are several monetary policy instruments that can be used to tackle the climate change issue. The first one is Green QE, so the one that I will be discussing today. And the idea is to somehow to buy bonds that are that are without that are related to firms without CO2 emissions. And there are three different kinds of green QE. So one possibility that has been put out is to replace corporate bonds that come to maturity with new green bonds. So this has been explicitly mentioned by the Grove, and it is somehow related to the program that now the Riksbank has started. So basically they have decided to expand their asset purchases, and they are buying only some type of assets. So basically saying that the new assets that they will buy are only coming from firms that do not pollute. Another way is to greening monetary policy by tilting central banks' portfolio toward low carbon sectors. So actively changing the portfolios that we have accumulated in these years by selling brown bonds, let's say, so bonds that are related to firms that pollute more, to buy green bonds. Or to reorient central bank asset purchases toward green securities. For example, Brunnermeier and Landau have said that basically the central bank can try to target a different percentage from the one that prevails in the market. Another possibility is to give preferential treatment to green bonds in central bank collateral framework. So this is, I think, this is also in line with the seminar that was presented in this forum 2 weeks ago. So basically to say that bonds that comes from firms that do not pollute have a lower haircut when they go to the central bank to get the liquidity in open market operations. Or like the third point is to internalize climate and financial risk in central banks model, and this has been proposed by many authors. Clearly, proposal 1 and 2 violate the market neutrality principle that, for example, in the Eurosystem has been one of the main culprit, at least for now, for asset purchases. So the idea that that central bank cannot change the relative prices of bonds that are on the market to be neutral indeed. So what is our contribution? We try to study, like our research question is, if can central bank use their unconventional monetary policy tools to tackle climate change? And so in particular, we focus on green QE. We extend a standard ESG model for QE analysis with 2 sectors. So one green sector and one brown sector. So one sector that pollutes and one that do not. And pollution as an effect on the general equilibrium of the economy as in Nordhaus. And using this model, we try to so we build this model to have an analytical instruments to study central bank policies, and we study the transmission mechanism of green QE, and that like basically we label as central bank purchase of green bonds, and we studied different policies, so either a retilting of the balance sheet toward green bonds by selling brown bonds, or a balance sheet expansion but financed only through green bonds. And what we find is that the green QE is effective, first of all, so it has an effect on emissions, only if green and brown bonds are imperfect substitutes. So if there is a market segmentation such that the central bank intervention has an effect on the relative price of bonds, and therefore affects financing conditions of different firms, and can change actively the stock of emissions. Under imperfect substitutability, we find that the macro environmental and welfare effects, at least keeping the model of Nordhaus, are small and transitory. And here we also, the economic intuition is that the monetary policy is neutral in the long run. So if we want to have a structural change, so if we want to have a transition toward a green economy, a cyclical instruments like monetary policy is not well suited. So monetary policy per se cannot help to have a structural transformation of the economy. On this side, a carbon tax is more appropriate. So we are mainly related to two different strands of literature. One is the one that studies environmental policies in DSG models, starting from Nordhaus, the seminal work. Then we are also very close to the work of Oetel. While and on the strand of literature on QE, and in particular on those papers in which QE is effective, so Kurdi and Woodford, but we are mainly related to Gertler and Karadi as a structure of the model. So the two papers that are more related to our is Giovanardi et al. They do an empirical studies on the effects of different bonds of ECB announcement on environmental policy, and especially on the possibility of keeping into account emissions in the collateral framework. And they find that there is an effect on the relative price of these bonds. And then they build a DSG model to study like the general equilibrium effects, as we do, of this kind of policy. And the other paper is Di Luiso et al. That in a DSG model, they try to study transition cost to a carbon-free economy and how climate and financial regulation interact. And also they study green QE, but in a slightly different setup than ours, so they do not have this imperfect substitutability, and so they find a very small effect. So let me briefly present you the model of our economy. So we have a capital producer that produces capital for green and brown firm, and we have like household sector that can invest in two different liabilities. So either deposits that goes to the banks, or public bonds. And the public sector can, so through the central bank, can buy green and brown bond, or alternatively the banks buy green and brown bonds. Green firm and brown firm, in order to finance their investment in capital, must sell these bonds. So they must be financed either through the banks that can leverage on deposits, or through the public sector. These green firms and brown firms then produce an intermediate good that is used by a set of differentiated firms that sell differentiated goods to the household sector. So the differentiated firms use the following production function. As you can see, is a CES where YT is the final output, YTG is the green input, and YTB is the brown input. These two inputs are produced by perfectly competitive green and brown firms with standard production function, Cobb-Douglas. So how it works, our models, like very similar to Gertler and Karadi. So we have the private bank sector. So they have net worth and deposits on the liability side, and they can invest in green bonds and brown bonds. While the central banks can invest both in green bonds and brown bonds, but liabilities, its liabilities are only the public bonds that you can see as reserves, liquidity, basically. So in standard models, so without any kind of frictions, there is a no arbitrage condition between green bonds, brown bonds, and public bonds, and these free interest rates must be the same for like in any period and for everyone. So in these models, QE is not effective, because basically what happens is that the expansion of the central bank balance sheet does not change, does not have any effect on the return of the green bonds and brown bonds, and so also like unconventional monetary policy is ineffective, and so the so-called Wallace neutrality always holds in this case. But we, as I was saying, we borrow from Gertler and Karate, and we add a financial friction that makes QE effective and able to have macroeconomic effects. So the friction is the following. So basically, the households cannot observe perfectly what bankers do. And so since private banks, so the bankers, that the owners of the bank, can divert a fraction theta of their assets. So there is an incentive compatibility constraint that requires that in any period, the leverage of the bank does not exceed a fraction theta of their assets. So thanks to these constraints, banks cannot borrow indefinitely. And so there is a limit on their leverage. And after that, a spread opens up between assets and liabilities interest rate. So thanks to this financial friction, still we have that green bonds and brown bonds are perfect substitutes. So their return must be equal, but the return of the public bonds can be different and can be lower because there is no there is no problems of observability for the central bank with respect to the private banks. So in this model, QE works, and an increase in central bank asset is not fully offset by a reduction in bank lending, while it is the case otherwise. And so we start from here, basically, and we try to study what happens with green QE in this economy. But clearly, without further assumption, green and brown bonds are still perfect substitutes. So what happens is that whenever the central bank changes its balance sheet composition, the private sector, so the banking sector, can perfectly undo what the central bank is doing by reversing its position. So if the central bank is buying green bonds and is selling brown bonds, basically, given that these two bonds are perfect substitutes for the private sector, they simply do the opposite until the two interest rates are still identical. So basically, without further assumption, any tilting of the central bank balance sheet has no effects, as I was saying. So what do? We add an adjustment cost. So we introduce a quadratic adjustment cost that banks pay when they change the asset composition compared to the steady state B star that we assume is let's say, the market neutral balance sheet composition. So now what happens is that if the central bank buy green bonds and sell brown bonds, it has an effect, because now to change its balance sheet composition, private banks has to pay a cost. And in particular, like this is the log linearized equations that we get in equilibrium. So you can see that the spread between green bonds and brown bonds is related through the amount of green bonds that is owned by the private sector. And this theta captures basically the elasticity of the private sector to the spread. So let's say that it is the opposite, it's inversely related to this kappa. So the higher the adjustment cost, the lower this eta. So potentially, if kappa is infinite, this eta is 0, it means that whatever the spread, then the private banks do not change their balance sheet composition, and they let the interest rate the interest rate spread between green and brown bonds to open up. Otherwise, at the opposite, if this kappa is 0, this is like basically plus infinite, as I was saying before. So any adjustment from the central bank is perfectly undo here. So with respect to pollution, our model, like basically we borrow from Nordhaus, as I was saying. So we have a brown firm that produces CO2 industrial emissions. This goes into the stock of atmospheric carbon. So, and this has an effect on TFP. So this is a sort of dice model. And the emissions are like a convex function of the brown production. And we have a law of motion of atmospheric carbon pollution that is an AR1 that depends on today emissions of the country and on the rest of the world emissions. And TFP is this function where like there is a negative effects on the stock of pollution on TFP, and there is this quadratic form here. So the higher the stock of pollution, the lower the lower the TFP. So basically pollution has an effect on TFP. So the damage of pollution on the economy is captured through this function here. And then we have three policy instruments. So we have a Taylor rule for nominal interest rate, standard Taylor rule on like with a weight on inflation and a weight on output gap. And we have a QE rule that basically we don't target here. So we just let it have an autoregressive component, and that can be dependent on the QE shock. So this captures an expansion of the central bank balance sheet. And finally, we have a green QE. So what is green QE is another Taylor rule, but that is, okay, it has an autoregressive component, and it is targeted on the amount of brown output. So potentially the central banks for a given, so basically here we are splitting the two policies. QE is the central bank balance sheet dimension, green QE is the central bank tilting toward green bonds. So the higher the brown production, the more the tilting toward the green bonds. This is the QE rule depending on this Fiji, that is the reaction function basically of the central bank. So the calibration of the model, so like New Keynesian parameters are standard. For the banking parameters, we borrow from Gertler-Karadi, as I was saying. For environmental parameters, we borrow from Eutel because it is basically an Nordhaus model in a DSG framework. And we calibrate, so like the very specific parameters of our model, the brown sector size, this Xi, is calibrated to match a steady state atmospheric carbon of 867 gigatons, that is the 2020 level. And the elasticity of substitution between so the Xi between green and brown inputs is set to 1. So basically the function that I showed you before, we reduce it to a standard Cobb-Douglas. And for the adjustment cost, that is a critical parameter, I think, to discuss the effects of green QE, we try different parameters. So we look at what happens in different setup. And we perform 3 policy experiments. So in the first one, we do a temporary increase in the share of green bonds. So it's a temporary green QE. So the central bank tilts its balance sheet, given the size, toward green bonds by selling brown bonds. Alternatively, so the second experiment is a temporary increase in green bonds, but through an expansion of the central bank balance sheet. So there is an increase in total assets, but is only of green bonds. And finally, we study the effects of a positive TFP shock, and we study the effects of different green QE rule, basically. So when there is a green QE rule on when this is absent. So these are the results of the first experiment. So first of all, let me say immediately that, as you can see, there is no effects on macroeconomic variables. So this is a temporary tilting of the balance sheet. So so we have calibrated it to be 5% positive green QE shock. So green central bank bonds increase by 5%. Brown central bank bonds decreases by more because the share, so the central bank balance sheet in equilibrium is already more tilted toward green bonds. It's market neutral, but there are more green bonds than brown bonds. And here we are plotting the same shock under 3 different calibration. In the blue solid line, there is no adjustment cost. In the red dotted line, the eta that I showed you before in the log linearized equation is 10, and the black dashed line, the adjustment costs are infinite. So like as you can see, the shock on the central bank balance sheet is the same in all the three scenarios. But clearly in the blue line, in the blue case, so when there are no adjustment costs, so the two bonds are perfect substitutes, what happens is that there is a perfect offsetting of the central bank move by the private sector. So this is the green leverage of private banks, as this is the brown leverage of private banks. So basically what happens is that they undo what the central bank is doing, and indeed the spread between green and brown bonds is constant and stays zero. The other extreme is the black dotted line, dashed line. In this case, there are infinite adjustment costs. So what happens is that the leverage of a private firm does not move. So the green leverage, so despite the central bank intervention, they do not act. Basically, they do not sell their bonds. So here, clearly, the effects on the green-brown spread is maximal. And clearly, given that they are having an effect on the spread, there is an effect on green capital, on brown capital, and there is a decrease in the brown capital and in brown output, and therefore there is a fall in emission by minus 0.6% with a 5% increase. But still, the effects on the overall pollution is small. And then finally, the red dotted line is an intermediate scenario that we kept also for the other experiments. And here, clearly, you can see that is basically a convex combination of the two previous scenarios. And here, the effects on emission is almost 1/3 of the infinite adjustment cost. This is the second experiment. So here we are having an expansion of the central bank balance sheet, but we are plotting either an expansion through only green assets or an expansion market neutral. So following the market neutrality principle. In the blue solid line, there is the market neutral one, while in the black dashed lines, QE is only financed through green assets. As you can see clearly as before, the green-brown spread opens up always clearly only when you deviate from market neutrality principle. And what here is interesting to see is that clearly, given that there is a central bank balance sheet expansion, this policy is effective on macroeconomic variables. But the difference between the market neutrality intervention and the one targeted only on green bonds is negligible. So if you look at the macro variables, is very small. And finally, in the third experiment, we assume that there is a positive TFP shock. So the economy is growing. So you are it is in the positive side of the cycle. And we study the reaction of the economy when the green QE rule is present or when it's not. So in the blue solid line scenario, there is no green QE, so central bank is just acting like with the other two instruments. While in the black dashed line scenario, there is the rules that I showed you before. So with a Taylor rule on brown production that basically on emissions, with a Fiji that we set to 10. So what happens is that under green QE, under the green QE scenario, the positive TFP shocks clearly activates central bank intervention. So central banks buy green bonds and sell brown bonds to try to compensate the increase in emissions that has been generated by the TFP, by the positive TFP shocks. and open up the spreads between green and brown bonds, given that they are imperfect substitutes, there is an effect. And in both cases, given that there is an expansion of the economy, there is an increase in emissions and an increase in pollution. But under Green QE rule, clearly the increase in emissions is smaller than without. So the central bank can somehow compensate for the positive effects on pollution and on emissions of the expansion of the economy. So let me basically go to the almost to the conclusion. So what we find with these experiments is that a transitory green QE has very small effects overall. And there are two reasons, basically. So pollution has a very slow law of motion. So the decay rate that we set according to Nordhaus model and so to scientific studies on pollutions is 0.998. So even if there is some effect on emissions, the overall effect on pollution is very small. Due to the fact that there is a huge cumulated stocks of pollution. And under current value of atmospheric carbon also, so remember that I show you that there is a quadratic effect of pollution on TFP, and clearly, so this is a convex function. And so given the current stock, and given that we are studying a log linearization around the current stock, the first derivative of TFP damage with respect to carbon is still relatively small. The higher the increase, so the higher the stock of pollution, the higher the first derivative of the negative effects of carbon on the economy. So this is dependent on the current state. So, and also under TFP shock, curbing pollution with a cyclical green QE rule yields negligible welfare gains, at least keeping the model of Nordhaus as we did. So with respect to permanent policies, so the problem is that green QE works only if green and brown bonds are imperfect substitutes. And our adjustment cost device basically creates a market segmentation such that under a transitory shock, the central bank can have an effect on the relative price. But in steady state, adjustment costs are zero by definition. Basically, you can think as those imperfect substitutability as being temporary imperfect substitutability coming from portfolio adjustment cost or something like that. But it is hard, at least looking at the literature, to think that there is something that can stays there forever. So basically, balance sheet intervention, as any other monetary policy intervention, has no effects in the long run. Because otherwise, if we have to relax this assumption, we should also relax the assumption that monetary policy is neutral in the long run for other kind of intervention. In the standard neo-Keynesian literature, let's say. On the other hand, what we find is that clearly a permanent tax on production has an effect, and is permanent and does not go away in the long run. And we find an optimal tax that is like very small, 0.4% on brown production. But this is, you must also remember that our model is a DSG around a steady state and is not a growth model. So probably we are not internalizing the long run effects of pollution because other studies find much higher effects. But nonetheless, like, we try to study the alternative policy just to have an idea of what was going on. And so clearly, if you add the utility cost of emission, then basically this is going for sure to affect the results. So if you think that emissions does not only have a negative effect on TFP, but also they have a negative effect on the utility of households for many reasons, then the effects of like green QE can not be negligible. And given that this is So basically, we have shown that it has some effects. The only thing is that given that it has no effects on macroeconomic variables, there are no effects on the utility of households, basically, or I mean, they are very small. And so like brown sector size in our model, we model, so we have a very large green sector because basically, as I was saying, we calibrate this parameter to match the overall stock of pollution, but we have also done some sensitivity analysis. So what we tried was to change the relative share of this sector and to add an abatement technology that was reducing the pollution of the brown sector, but was not an important parameter according to our analysis. And clearly, as I was saying before, like reducing the persistence of pollution or increasing the TFP damage to extreme values, so when the derivative is higher, can have small effects, but still has an effect on the positive welfare gains of green QE. So let me sum up the presentation. So we have set up an analytical framework because basically, as I was saying, we wanted to have an analytical instruments to analyze and to discuss the policies that are now discussed in many central banks around the world of green asset purchases of the central bank. And we have shown that green asset purchases are effective only if green and brown bonds are imperfect substitutes. And like per se, effects of green QE on macroeconomy, environment, and welfare are small. We plan to extend and to do future research on this issue. For example, if this green QE is used to finance abatement technology, so basically to greening the brown sector, or to add, as I was saying before, welfare loss related to environmental variables on the household sector. And also, clearly, another issue is coordination among countries on environmental policies, because we were using a small open economy, even if like it was calibrated on US. But clearly, the pollution is also coming from, as I've shown, from the rest of the world. So still, the effects on overall emissions is limited, but in a coordinated environment, this can be different. And thank you.
Thank you very much, Alessandro. So please, if you want to ask a question, use your Q&A function here, or you can also raise your hand, I think, if you can. In the meantime, Emanuele Campiglio asked to elaborate a bit on what are the adjustment costs for banks that you have in your model. So in reality, what could that be, or how can we think about that? And on my side, I would like also to ask you about the green bond rule that we introduced for the central bank. So what does the central bank exactly does? Why does the central bank follow this rule? And why, for example, not having like a permanent tilt instead of a temporary tilt, or you know, a longer tilt than just a temporary one? So maybe you can start with that.
Yeah, so let me start with the adjustment cost. So the idea is that, like, for example, there are trading costs. So for a private bank, it's costly to change its portfolio composition. So when the central bank intervenes, the private sector is willing to let some spread open up instead of immediately acting to compensate. So if the central bank is buying green bonds, and I see on the market that now the green bonds have a lower return, and I have a lot of green bonds in my portfolio, but I don't want to sell them just to make profits of the spread because it's costly. I have to activate someone to sell them. So there is quite a lot of research in finance literature on the preferred habit investors. That is also basically behind other type of central bank intervention. And so I think that also, so we can speculate, I would say, that there are also potentially other reasons that maybe are more long-lived than this just temporary and like short-lived adjustment cost that can also, for example, come from corporate social responsibility issues, or who knows, in the long run, maybe financial regulations, so that forces banks to have a certain share of green bonds. And like going on another side in which there is already regulation, for example, we know that central bank intervention in government bonds is effective because for financial regulations, big investment funds, pension funds have to detain a certain amount of these bonds, and they are treated differently from other bonds. So by making these bonds more scarce, central bank is able to create and to open up a spread and to create scarcity. Otherwise, as I was saying, if they are perfect substitutes, central bank cannot create scarcity. So with respect to the rule,
let me add just one thing, Ale.
Yes, please.
No, regarding the bank adjustment cost, this is really, of course, a reduced form device, but the important thing here is that banks we need a device to make banks forced to not adjust the balance sheet in response of green QE. Otherwise, if banks are free to adjust, green QE doesn't have any chance to work. So really, this is only a reduced form device that, of course, could be microfunded in a lot of ways, as Alessandro has just listed.
Yes, and so with respect to your question, Pierre, so on the temporality of the central bank intervention, so the issue is that in this kind of model, by construction, so given that, as I was saying, this adjustment cost is crucial to have an effect, if we assume that central bank intervention is forever, then basically if adjustment costs, as I was saying, are depending on the steady state level of the bonds, then basically these costs just disappear. So the idea was, okay, in a cyclical model, so let's study what can a cyclical monetary policy do, and what we find basically is that, so given this convexity of the cost of pollution, so let's say that deviation above the steady state level of pollution are more costly than those below. So basically, when there is a recession for the central bank, potentially is less costly to have more brown bonds, while when there is an expansion, the central banks tries to compensate the increase in emissions and in pollution that is coming from the economic boom, buying more green bonds. So this is the idea. So basically was to study something on the cycle. So given the model, what we can do is to study something on the cycle. To study something on like more permanent, we are doing it. So we are working on it. But still, you have to assume. So I mean, I think you have to make some strong assumption, I believe, on why these bonds are imperfect substitutes forever. And it can be the case, as I was saying, a regulation, for example, or also, as I was saying, corporate social responsibility. So you can assume that households prefer to have a green bonds with a lower return than a brown bonds with a higher return, just because they care about the environment. I mean, I think this is credible, but yeah, I mean, we are deviating from standard literature on finance, but still, it's an interesting development, and we are working on it.
Yeah, for permanent green QE to work, you need monetary policy effective in the long run. So you need to break down the monetary policy long run neutrality, basically.
Now, I mean, listening to you, I realize that you're speaking a lot about green bond, and if you have people working on financial markets, hearing that when you say green bond, they have a very typical type of asset in mind. But just to make things clear, I think when you speak about green bond, you speak about bond that are financing sustainable activities and not the label green bond per se.
Yeah, so in the model by green bond, I mean a bond that is financing capital investments of firms that do not pollute. So basically that they do not raise any kind of greenhouse emission, while brown bonds are like 100% brown production. So yeah, I mean, it was clearly it was just a simplification of the model. I know that there is a convex set of combination of these two extreme.
I'm just precising because there is a lot of in the policy discussion when we talk about central bank to be more sustainable or to buy more sustainable asset, it's often associated with the label green bond, and then the market of green bond is relatively small now, so it's anyway impossible for central bank. But the label green bond doesn't cover all sustainable activities. Some activities are not labeled green but are sustainable as well. So that's why I wanted to precise.
Yeah.
The next question comes also for me on basically to be provocative. How confident are you in your numerical calibration, empirical calibration? I mean, you know all the controversy on Nordhaus model, when you also say what is the margin of security about your estimates, and wouldn't it be, for example, that you could say we have here a lower bound for the effect because we might find in reality we might find other coefficient, or basically about how you calibrate it, and will you really use it to make forecast, or is it just to study the qualitative effect and the direction of things, and not really the estimate that you have when you say it's a small effect, but a small effect compared to what, and this kind of issue.
Yeah. So let me also, so I would say, it is a calibrated model, so it's not estimated for sure. And I know that the Nordhaus model is like nowadays considered the lower bound of the effects of pollution on environment. So this for sure is can be the lower bound. Still, let me add that we also tried basically the highest possible imperfect substitutability of bonds, and also consider that in our model there is no cost from QE. I mean, so you only have marginal benefits, but you do not have marginal cost. So, for example, in the paper by Gertler and Caradi, they assume that at a certain point the central bank is less able than the private sector to monitor the firms, and so is less efficient in keeping the bonds. So so I would say that it is true that on the one hand we are like basically using the lower bound of the economic models with environment, still probably the only one that fit the ESG model, so we were somehow constrained. On the other hand, I think that we are also dismissing other costs that can arise from this kind of central bank intervention. So I would say that we did our best. Then we also did some sensitivity analysis. So I'm not totally sure is about how to put emissions inside, for example, utility, and how to add welfare cost that comes from other sources. And so, but I think that the real issue is that I really believe that that climate change is a real serious issue, and that damages are really big. Clearly, so we have a business cycle model. So we are studying policies over the business cycle because monetary policy acts over the business cycle. Clearly, if you use a growth model and if you look at the effects of a tax, for example, in a different model, then clearly you get much different result. Also, if you use green QE in a setup where it's effective in a growth model, then you have different effects because, as I was saying, so the issue is how much you forecast of the future damages. And clearly, in this kind of model, I think that you couldn't do more. So I would change the question in: do you believe that monetary policy is effective in the long run? And if you say yes, then probably I would say that this is really a lower bound. If you say no, I would say that this more or less is the effect.
Amelia, you want to add something? If not, there are
yeah, well,
yeah,
I think, yeah, of course, around environmental parameters, but also around economic parameters, there is a lot of uncertainty. But here, really, the crucial parameter is the persistence of pollution. And pollution remains in the atmosphere for decades. So if pollution is really, really persistent, even if you're able to affect emissions with green QE, it's still very difficult to affect the stock of pollution, which is a very, very slow moving variable. So I think this is the crucial parameter in our paper, on top of the adjustment cost. So that's why, yeah, we believe that, yeah, if monetary policy is neutral in the long run, we can use only a temporary green QE. But a temporary green QE has a very hard job to affect a slow moving variable such as pollution.
I mean, just touch upon one of the remarks that I made to myself when you were doing your presentation. So basically, you say that, I mean, I would take the stock of emission like an exogenous variable that you cannot almost not move because it's so moving. So basically, the goal of a central bank or a policymaker would be to reduce emission, because that's what drives pollution in the long term. But it's the only variable that you can act on. I mean, we know that the pollution in the atmosphere now is going to affect us for a decade anyway. So I would on my side, I would emphasize emission rather than the stock.
Okay, so but then I would say that the utility cost is crucial, because basically then you look at the flow. The issue is that the effects on the macroeconomic variables, so the effect on TFP, the effect on economic growth, is coming from the stock. So this is the issue. So if you just say people care about the economic variables, then you have to take the Nordhaus model, and the Nordhaus model says you blah, 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 blah. But if you say people, as I was saying, for example, care, and they don't like to have emissions, then basically the stock counts zero, and the only thing that matters is utility of households. Clearly, I mean, then what you were saying that central bank has to look at, still, I think that this raises an issue that we have avoided clearly in our paper, because we were focusing in having an analytical tool that we thought was missing in the literature. But clearly there is also a political debate on, so are independent institutions the one that have to take all these kind of goals? And if they are, I think that this is I mean, that can be okay, but do we have to, so is this compatible with treaties of actual central banks? So I think that there are also legal consideration. I think that one can say yes, but I mean, I think that this raises a legal and a political issue that is not so taken for granted, at least.
I mean, this debate has been ongoing for some time now, and there are different opinions on it. But as you say, I think the value added of your model, as I see it, is to give to explain the mechanism that a green QE with a trigger, and I mean, from a purely economic point of view, or economic theory point of view, and not from mandate, or should we not do that? That's very useful. Maybe a few round of last questions. So Luca Tascini asked us to elaborate about more on the comparison between QE and carbon tax. If you have something to say on that.
Oh yeah, okay.
And
So
sorry, and second question also, someone asked whether the adjustment of changing production from adjustment cost of changing production from green to brown, from brown to green, could that be something that is equivalent from the cost for the banking sector of reallocating the so maybe is there a parallel there, or is that something totally different?
So sorry, can you repeat the second one, because I was looking at the chat and I saw another one, but I missed the second one that you mentioned.
The second one was in the chat. It's about yeah. So usually we have adjustment costs to physically change production from brown to green.
Okay.
And would this adjustment cost be equivalent to the adjustment cost that you use for the banks to change the asset?
Okay.
Because it's a crucial factor for your model.
Yeah, so with respect to the first question, the comparison between QE and carbon tax, the fact is carbon tax has an effect on the steady state, basically. So with a carbon tax, you are able to permanently change the share of green production with respect to brown production, because it has an effect on the cost, on the relative cost of the two goods. And so basically there is an adjustment standard green tax. So I was making a comparison by saying that QE is a cyclical instrument while carbon tax is a structural instrument. So we find a very small carbon tax given that we are studying the model around a steady state. While if you look as for example, as we were saying, to like a growth model with a longer horizon, you find higher optimal carbon taxes. So the main difference is that you can set up the carbon taxes and stays there, while with QE, basically at a certain point, we have that its effect vanishes because of neutrality of monetary policies. This is the idea of the difference between the two. So if you want to have a permanent effect on the economies, as it is the problem of pollution, then you like a tax is preferable because stays there forever, as an effect on relative prices, changes the production sector forever. And so with respect to the second question, so there is, I think, a small differences between the adjustment cost that you usually see on firms and on capital production, and it is the fact that is dependent on a steady state level and not on the previous period capital. So it's not an adjustment cost with respect to the previous period, as maybe it was more natural to think about it. And this is just because like it's a problem of aggregation. So it's a simplification that we do to aggregate among different banks and to have a rule for like an equation for all the banks, as in Gertler and Karadi. So it's a simplification, but it's very similar to the capital standard adjustment cost.
By the way, we do have investment adjustment cost in the model. And
so yeah, so.
Yeah, so, but yeah, with investment adjustment cost and without bank adjustment cost, green QE is not effective. So the important thing here to make green QE work is to not allow banks or households or the private sector more in general to freely arbitrage between green and brown bonds. So an investment adjustment cost cannot do anything about it.
If you still have 5 minutes,
yeah.
I mean, there are two last questions coming from first from Andreas Breitenfelder. So, what about the signaling and credibility effect of a green QE? And maybe a question more philosophical, but it is important in this context, is when you think that we have the next 10 years or 20 years for solving the climate change, is this long-run neutrality result of monetary policy really relevant for your views?
So I start from the second question. So I think that this is the issue. So the issue is that given that the next 20 years are the most relevant one, so I think that this is also in line with our findings. So you can think of green QE or any kind of central bank intervention as a support of other policies that has to be taken if we want to avoid climate change. So I would always, so I would also underline a positive message from the paper. So if you care about climate, so do not think that the central bank intervention or any kind of financial intervention is enough to tackle the issue. So we need a coordinated action through a carbon tax or an emission cap. To some scheme that is able to do that. Then if some scheme is in place, then is a sort of central bank intervention able to provide an additional mitigation of the effects? This is likely the case. So I would say that the real issues is exactly this one. So that in the next 20 years, you must think of some policies that are able to transition the economy to another steady state, to a greener economy. And central bank per se is not able to do that, but central bank probably is able to mitigate and to help this kind of transition. And so I agree that this long run neutrality somehow can be mitigated, but only if it is mixed, or if the central bank intervention accompany other kind of policy intervention. And so with respect to the signal credibility effects, this is a question that we usually receive. It is true, so this is not in the model. You can think that the central bank intervention can create liquidity and demand for this kind of assets, and that can help green firms to issue new bonds. Yeah, this is unfortunately this is something that we do not have in the model. So but you would need a more complicated and strategic model.
Thank you very much, Alessandro. I mean, I just want to underline your last answer. Indeed, I think nobody expects central bank to save us for climate change alone. It definitely needs a coordination and the alignment of all available policy tools, financial policies, but also fiscal policies and trade policies. I mean, the challenge in front of us requires that all these tools are coordinated, and the carbon tax solves solution only in textbooks. In real world, I think all policy can contribute a bit to this impact. Thank you again, Alessandro and Valerio. Let me remind you the next panel, the next e-seminar on the 22nd of February, which will be a policy panel, a bit longer than usual, 1 hour and 30 minutes. And in the meantime, please join the Slack pages where you can find all the information about this seminar and continue to ask questions around it. Thank you very much and see you in 2 weeks.
Thank you. Bye.
Thank you. Thank you very much.
Thank you very much.